Joining us at Post 9, RBC Capital Markets Head of Equity Strategy, Lori Calvasina, with her target of 42.50. You were here a few days ago, Lori. We talked about the target. Has the yield picture since then changed anything in the playbook?
Not really. You know, it's funny. A couple weeks ago, I put some stress tests, and actually, I thought I was going to get all these questions. If yields are at X, what should the PE multiple be? And so we put these stress tests out, and we found that if you took a 6% 10-year yield and ran it against our regression, and our data goes back to 1962 and just says, you know, if the yield is X, what should the trailing PE be? It spit out the number 19.4. And if you multiply that against our earnings number of 220 for this year, it actually gets you a little above 4,200 on the S&P. So it sort of, you know, explains to me why we're sort of meandering around this level right now.
But you got a lot of individual stocks and or even sectors that are getting hit as a result of indebtedness, refinancing needs, just sensitivity to interest rates.
Yeah.
And that starts to add up.
It does. And, you know, that's been a big concern on the small cap space right now. And it's interesting because the data you can pull in the small cap space, you know, whether you're looking at the effective interest rate, the amount of variable rate debt, it's not quite as bad as people have in mind, but there is a lot of opacity around some of that data. So I think you're just seeing the market say we're going to shoot first and think later right now. And that's really what I think happens when you have a very fierce, quick move up in yields is you shoot first and think later.
Right. But is there a playbook that anything that history can tell us in terms of what the right thing to do is during that kind of period?
Well, typically the thing you want to do when bond yields are surging is buy things like energy and financials. And those were working, or at least energy was working until recently. And now, you know, as Halima was saying this morning with Sorkin, you know, you're sort of caught up in a macro storm there that's overwhelming the fundamentals. But I think that's what's interesting is because this bond yield move tells you to beat up on the growth sectors, and we were doing that. But at least as of, you know, about 20 minutes ago, we looked like we were getting a little bit of stabilization there. So I think the market is just fighting a lot of very complex cross currents. It can focus on one thing for a few minutes and then it shifts to something else.
But Lori, isn't the problem with the higher yields that it increases the odds of a hard landing or a recession, the consumer shock, which if you say that the market's resilience this year is built on the soft landing narrative, doesn't this just throw that out the window? No matter what the level of yield is, the speed of the move that we're seeing so far just might be too much at a time where, you know, student loan payment resumptions, we're seeing all these strikes, the job market is starting to weaken a little bit. I don't have to tell you all the headwinds.
No, I think that's a good point. You know, I think a couple weeks ago I was talking to someone and we sort of decided that it felt like the soft landing pendulum had swung too far back in the complacency direction, that we've kind of oscillated back and forth between we're definitely having a recession, we're definitely not having a recession. So maybe it was just time for that pendulum to switch back. But you're absolutely right, Sarah. I mean, when we've tested sector performance against moves in bond yields, one of the most consistent relationships you see over time is that the consumer sector, at least, the discretionary sector, underperforms pretty badly. Now, I do think that whether or not you're sort of saying we're going to have a soft landing or maybe just a mild recession, we know growth is going to stink for a while, and I think maybe that's one of the reasons why things like tech are getting a little bit of stability today. Even though they should get beaten up by the bond yield, if the impact is the negative knock-on effects to the economy, you do actually want to be in secular growth stocks in this environment. And that's why this just feels like it's enormously complex right now.
I mean, it's a really interesting point, because I was going to ask you, if you're worried about the economic environment and the shift to the hard landing, you would go to staples or utilities. But guess what? Those are performing even worse than the cyclicals right now because of the yield move. And then you'd go to technology during a low growth environment. But that's risky, too, right, when it comes to the multiples and which sector tends to get hurt. So it's a tough call.
It's a really complex call. You know, utilities is really funny. You know, I was telling Carl and David over the break that someone was making an argument to me right before utilities cracked to value it on a PEG ratio, and it didn't look that expensive because I was actually pushing back against the move saying, hey, it's too expensive in here. I don't care if the market takes a breather. I'd rather play defense in something like healthcare, which doesn't have fundamental problems to the same extent, you know, and has better valuations. And I thought it was funny that we saw that sector, you know, when people were trying to, you know, kind of stretch to make valuation arguments, that suddenly we saw the bottom fall out from it. So I think there just aren't good choices in defensives right now. Staples, I think, has a pricing problem, and you're starting to hear a lot of companies across different sectors and industries say, look, inflation is moderating. We don't have as much pricing power as we used to, and Staples is caught right in the crosshairs of that, so it's hard to play defense there, too.